We promised to share some stories of how McPhee Insurance clients have implemented infinite banking.
We're also going to talk about a real estate meeting, a county fair, and sourdough bread.
I recently attended a meeting where a group of real estate investors were talking about what color they are painting their rental properties. They're saying that light gray colors are on the way out, while light brown colors, warmer colors, are on the way in.
That sounds like they want to get on the bandwagon, do what everybody else is doing. And that can be a good thing if it's the market driving that. It can be something else if someone's telling you this is what you've got to do.
Yeah, it's interesting. One of the things they were talking about is how the colors are set, even a few years ahead of time, by a group in New York. It's kind of interesting, but you think about it, the designers have to have something to work toward. So who's deciding what the colors that are in are really going to be here in 2 to 3 years?
Talking about getting on the bandwagon, sourdough bread is a big thing right now, but our daughter started baking sourdough bread right at the beginning, maybe, of that craze. Her sourdough starter is about 9 years old. She's famous for her sourdough bread. People buy her starter from all over the world. And she recently entered a loaf of her sourdough bread into the county fair. Now, she took a prize for this, and she had comments back from the judges. And one of the comments was, you should bake it a little longer so it has a darker color. Well, Anna says she prefers to bake hers longer for a darker color, but her market, her customers, they prefer the lighter colored bread. So here you might have some trends. People think, oh, you should have dark sourdough. But when she's actually at the market selling her products, she's baking it a little less so the customers buy her bread. It's the market that determines if something is going to be successful. And she is catering to her clients, so she is doing what they like.
That's exactly what participating whole life insurance is. It was a market-demanded product to begin with. Customers said, look, we want something that develops equity. We want cash value in a product, not just term insurance that you pay forever. And if you don't die, you don't ever collect any benefits from it. And so participating whole life was created. And now we have a product that works great with infinite banking.
One of our clients recently using infinite banking, Daryl and Joyce, they live in the Adirondack Mountains of New York, and they weren't planning to use their policies for replacing a roof. But a tornado came through the area and it took off their roof and the roofs of several of their neighbors. And once they had the damage assessment, property insurance companies, it turns out, move kind of slow in getting things paid out. So they went ahead, took a policy loan, got the contractor started right away on repairing their roof so they didn't have any further damages. And once the property insurance company did pay out, then they didn't have to wait through the big backlog of other jobs as their neighbors got their roofs fixed and the contractors were very busy. So maybe not a super exciting way to use the infinite banking concept, but it's definitely a way it illustrated the options and the opportunity that was available to Daryl and Joyce because they were using the infinite banking concept.
A story of being able to replace your roof after a tornado, that isn't necessarily a real glamorous sell of infinite banking, but it's real people doing real things in the real world. That's what infinite banking is about. And sometimes you do get to use your policy for something very exciting, the cash values, but not always. Sometimes you get to do something very practical at just the right time and at just the right price.
But look at the options. They could have put that roof repair on a credit card. They could have got a home equity line of credit, and they could have paid it off just like they're going to pay their policy loan off. And all the money that they would have paid would have gone to the credit card company or the bank. Now, when they repay that loan, they're going to get that money back. Plus, they're going to get the growth that was in the policy happening all the time that they were repaying that loan.
Recently, Jeff contacted us and he said, I think I need about $90,000 for something I want to purchase. But I think I only have 30,000. Well, Jeff bought policies on himself, his wife, his children, and he's been using those policies for many years. He borrows from them and he pays the loans back. And so I looked at the cash values in Jeff's policy. Now, I don't like to be the bearer of bad news ever, but this was a great time to report back to Jeff because he had over $89,000 in his cash values. Those policy cash values were growing all the time, and Jeff hadn't realized how much they had grown. He was only like 800 something short of that 90,000.
That's a great surprise.
It was a wonderful surprise. And it turns out that he was going to buy a piece of property, and he decided he actually needed quite a bit less than that to put the money down on the property. And so he's even going to leave an extra cushion of cash in his policies. That's exciting.
Thinking he only got $30,000 in cash value and having almost 3 times that, that's a good surprise.
Yeah, he had to be very excited about that because that really changed his opportunities. And it changed the discussion of, I need 90,000 to, oh, well, maybe I can only get by with 50,000 because all of a sudden he's got money and he has more options because he has the money. It's amazing what, the richest man in Babylon, they talk about having coins jingling in your purse. The gold that jingles and how that makes you feel more affluent and more like you have options. And I think that happened to Jeff too.
Being able to think differently in that way, it's a different, instead of being in survival mode, it allows you to think more creatively.
When we were in Oregon, Elena came to one of our meetings and we were talking about how infinite banking can build cash reserves in a whole life policy, and then you can borrow them and fund things. And in doing that, you recover the cost of what you were going to purchase. And she bought a policy on her life, and her husband was kind of mocking her that she did this. But at property tax time, he was thinking, how am I going to pay the property tax? And he says that he always used to just get a bank loan to pay his property taxes and then pay it back over the year. And this year, Elena says, I've got the money. I'll loan it to you. And that perked up his interest. And he said, wow, how did this happen? And pretty soon they realized together that this was something that really worked. And I remember Raul saying later on that his brother needed some dental work and he was going to need to get finance that through either a credit card or a bank loan. And Raul said, no, I'll loan you the money to get your dental work done. So not only were they their own banker, they became the banker for somebody else. Now someone else is paying their loan back. It's not coming out of their pocket, and they're building the cash reserves back in their policy, plus getting the growth on it while that's happening.
Raul was a little bit late to the party, but he loves infinite banking and he loves to share the news with other people. And they often refer people to us because they say, hey, this helped us. I know I can help you.
One question that often comes up as people are just starting the infinite banking concept is, how soon can I take a policy loan? And Jerome recently had this question. He had started a policy. He's still in his first year. So he wasn't sure if he could take a policy loan, but he wanted to know, can I? Got some health expenses that are coming up. I could use a policy loan to help cover these. What was that like as you took that call?
Oh, absolutely. He had money that was available to him and that he could borrow. He doesn't have to wait a full year or 2 years or 10 years or whatever it is. He can borrow a portion of what he's already paid in. He has cash value because he has some paid up insurance. And so, yes, he can borrow. And of course, we will help him with the paperwork because he doesn't want to mess up his policy. We don't want him to mess it up either. And so, of course, we'll be able to help him.
Now, some insurance companies, they do require that you wait a year, but none of the insurance companies we work with do. How long does it usually take when somebody starts a policy for them to be able to take their first policy loan?
Well, if they have provide proof from the bank that their payment cleared, they can take a policy loan right away.
Right away.
If they've made a payment.
So I'm
Right.
listening to Nelson Nash years ago when this question was asked in his seminars, and he always said, the question is how much have you put in? So how much cash value you have is directly related to how much you've put in. And here's the thing. Infinite banking is a process of recovering the cost of what you finance in life. And we finance everything. We either spend our money and it's gone, or we use someone else's money and pay our money back to them and we don't see it again. Infinite banking is a way to build up a reserve so that we have the leverage, just like all banks have to have a reserve. They loan that money to someone else. We can loan it to someone else like ourselves or someone outside ourselves. And when those payments come back in, it restores it, and there's a profit made because of the growth in the policy plus the interest that was being charged to the person we loaned the money to. Now, does that mean that we should borrow money from a policy for every little thing that comes along? Well, then we might not have enough money there for a roof if the tornado comes, or the medical expenses. So we have to be wise about this and always keep a reserve of cash values there as our cash cushion, because it's the best place to keep money.
Our client Randy contacted us recently. He has life insurance policies and he has borrowed from them. He's borrowed to make some investments that he knows about. The other day, though, he was calling because he wanted to ask me about taking a loan to purchase a home. And he wasn't just thinking about a down payment, he was thinking of purchasing the home outright. So we discussed that. Was it a good idea? We discussed the interest rates versus the interest rates he had available through a mortgage company. And we also talked about what he would have in reserve that he felt comfortable having a cash cushion. After we discussed that, he decided, yes, I'm going to take policy loans. You see, his idea in purchasing this home isn't an investment property. He wants to purchase this home for his son to live in. His son can pay him rent, but his son's busy getting a business going. He's recently married, he's got a baby, and he's getting his business going. He wants to be able to help him out. Towards the end of the call, he also said, this will keep him close instead of having him move halfway across the country where he thinks he can also do business. Oh, that was very apparent that Nelson talks about he who has the gold makes the rules. Randy's got the gold and he can help his son and keep his grandson nearby. I love that. That was the bigger story. And yes, he is in the process of taking policy loans to make that home purchase for his son, for his grandson. They love to have them close.
He's not buying this as an investment property, so now he has a little bit more flexibility on his loan terms. Interest rates have been up in the last few years. And that means the payments to have a mortgage are also up. Well, having an interest rate that's going to be below what the market interest rates are on those mortgages is going to give Randy some more flexibility on how quickly he pays that loan back. He could even choose to pay just interest only back for a while if that helps out with cash flow. You were just talking about leaving enough in your policies for a cash cushion. That's really important too. And you have flexibility in how you pay these loans back. It's a beautiful thing that helps you to maintain the right balance. That's a question that we often get when people are saying, well, how quickly should I pay this loan back? Should I take a long time so I have a high volume of interest, or should I take a short time so that I have the money back to use over again? And that really is the balance. There's not one size fits all answer.
And I love it too, because now he has flexibility in how much he charges rent to his son, knowing that his son is also working on this business opportunity. When we get back from the break, we're going to talk about another grandfather, and then we're going to talk about some of the questions our clients bring to us.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot, and it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts, and the people who put it into practice get results. Don't let insurance terms like modified endowment contract, 7-pay test, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
If you've been enjoying these client stories of McPhee Insurance on infinite banking, there's a lot more of them in the back of Prescription for Wealth. You can get Prescriptions for Wealth if you're watching on YouTube in the description, or you can go to mcpheeinsurance.com and go to our store. It's a free download. Either way, you should get it.
About 15 years ago, our client Ben paid for policies for his grandchildren. I talked to his granddaughter the other day. She became the owner of her policy a couple of years ago. Since then, she's been married and she now has an 8-month-old son. Right now, they are purchasing their first house and she needed to take a policy loan. She told me she never knew that buying a house could be so stressful. But we were discussing the gift her grandfather gave her, and I told her she should go and give both her grandparents a hug because although Ben's name was listed as the payer, we know that the grandmother had a great part in that as well.
That's a beautiful story.
It is. And, I hope she does go and give her grandfather a hug, and then he gets to hug his great-grandson and realize the gift that he gave to his granddaughter is now going on to the next generation. And what a wonderful thing that he can realize is that his gift of years ago is blessing them today.
I was talking about the legacy of life insurance with Michael the other day, and he was wondering whether he should pay his premium again this year. He's getting older. He's 70, and he's wanting to know, should I really pay this premium? What is into it for me? Can't I take this $20,000 I'm paying in premium and make a higher rate of return someplace else? And so we went to his policy, and we figured out that if he pays his premium this year, his cash values increase by 19% over what his premium payment was. I said, can you get a 19% return someplace else on your $20,000? He goes, oh, I don't think I can. And then I said, well, now let's look at it if you don't pay your premium. If you don't pay your premium, that means you put $0 out, your cash values still rise, and we can't get a rate of return unless we put at least $1 in there as premium. And if we put $1 in as premium, you get a 7,000% return on your cash value for the year. Now, granted, the cash value is going to be lower because he's not putting another $20,000 in there, but it gives Michael a way to think about, what do I want to do with this $20,000? And it really comes down to the legacy. If he pays the $20,000, his death benefit stays at over $800,000. If he doesn't pay it, his death benefit is reduced to just over $400,000. And so now he has something to decide, what is he going to do with this $20,000?
And any policy can be made into a reduced paid up policy. And so you have options to decide, just like Michael did. Do I want to pay the money and have that increased cash value, have the death benefit stay where it's at or increase? Or do I want to stop paying and still have an increase of cash value, have a one-time reduction of death benefit, but still have an increase in cash value, still be able to access the money? You have options on the table.
That reduction in death benefit is something that maybe is hard to understand, but whole life insurance, because it develops equity, is actually paying the death benefit off. Just like making a car payment. Every payment you're making a little bit more equity in the car. It's getting paid off. You make a house payment, you're developing equity because a little bit more of the house is paid off. Whole life insurance is the only insurance product that you pay off like that. And so when you decide, I would like to reduce this policy's death benefit, you're getting rid of the part that hasn't been paid off yet, and you're keeping the part that is.
So it's almost like if you had a home and you have quite a bit of equity in it, but you decide, I don't want to pay the mortgage anymore. And the mortgage company could just say, oh, okay, well, we'll take this back bedroom and this one bathroom and maybe part of the garage, and we'll remove it.
That's
No, they take the whole house.
But that's kind of, well, true, John. But that's kind of like what is happening if the same thing could happen that's happening with the whole life insurance policy.
good luck with a mortgage, but you can do that on a life
Yeah,
insurance
you're
policy.
basically downsizing. without
That's right.
Changing policies.
That's right.
It
So-
gives you flexibility to be able to do that. And, it's always exciting to share, to look at the stories of people who have paid off big amounts of debt using the infinite banking concept and then recovered all that money. It's always exciting to look at the stories of people who have started a new business with infinite banking and then recovered that, and they have the business at the same time that's growing and doing wonderfully. We get to see people purchase cars, help their children with their education, fund their retirement. Sometimes, though, there are also stories that are not exciting to hear, but people are better off because they were doing infinite banking. We don't hear these stories as often, thankfully, but there's this one that I'm thinking of. Him and his wife, they don't have a lot of other family, but they had elderly family that needed taken care of. And so they were caught between a rock and a hard place. They're taking care of family on both sides. And they're putting out a huge outlay every month. And they're starting to drain their financial resources. They're concerned they're going to have to declare bankruptcy.
That is sad.
But because they have their life insurance policies, their bankruptcy attorney is looking at this and saying, be sure you keep these life insurance policies, pay back some of the loans on them, because now you have asset protection here.
We've even had clients that have filed bankruptcy and their attorneys say, go sell your assets and put it back into these life insurance policy loans you have, because you'll be able to keep it because that's a judgment proof. And so, although that's not something we ever plan on, we don't ever plan on using our cash cushion either. But at the same time, it's there for us. That's going to make the future better if something drastic like that happens.
Well, we have a question from Don Mark, and this is just a great question. It comes in often, but he laid it out here really nicely, and so I wanted to share it with you today. So he borrowed $7,500 from his policy, and he set up an auto draft with the insurance company that they could draft a loan repayment from his bank account every month. He decided on the amount of $675 a month because he planned to pay this loan off in just 1 year, and he used an interest rate of 8%. Now, the insurance company was not charging an interest rate that high, but that's the rate he wanted to figure and charge himself.
How does that work? Can you explain a little bit about how that works? How can we charge ourselves a higher rate of interest when the insurance company is charging a lower rate?
We can set the payment amount, so we tell them how much we're paying, and it's in our notes, just our notes, that we're charging 8%. And so the loan is going to be paid off with the insurance company more quickly than on our schedule. So we are going to have some extra money that won't fit in the policy without making it, but it's going to be left in our control.
That's what
And-
Nelson Nash talked about, being an honest baker. If you're paying 29% on a credit card and you can borrow 5% from your policy, you better pay yourself back at least 20%, because otherwise that money would have gone to the credit card company anyway. You might as well enrich yourself. Maybe it all won't fit into the policy, but it will pay the loan back faster.
I want to get back to Don Mark's question, though. He has paid this $675 a month for about 3 months. And then he got a bill from the insurance company for the loan interest that was due. And he said it's 5.65%. They're charging me $154. I thought I was already paying this 8% loan. Why are they sending this to me? This is a great question. A lot of people have it. So what it is that the insurance company is charging an interest-only loan, and it's a little different than other kinds of loans that you have. So when Don Mark makes those monthly payments, it decreases the loan balance very quickly. But insurance companies charge interest once a year at the policy anniversary date. Doesn't matter when the anniversary date is. They look and see, what is the current loan balance? And they send you a bill based on the current loan balance. If Don Mark has been sending in these payments like he has really already covered the loan interest. And so he can just ignore that bill for that loan interest. And when he doesn't pay it, they're going to take the balance out of the loan. So it's like he paid the loan, got the loan balance down, and now they're just going to go increase that loan balance a little bit to cover the loan interest that was due. And I used a little more simple example as well to explain this. Let's say you have a loan out for $50,000 and you've paid $49,000 of it back. Your anniversary date comes and the insurance company is going to look at the balance and say, oh, they have an outstanding loan of $1,000. And if they're charging 5.65%, that means they're going to charge you $56.50. You don't pay it, your loan balance is going to increase $1,056.50. You can get that paid off very quickly, but that is what's happening, whether it's round numbers like 50,000 and 1,000, or whether it's unusual numbers like your numbers. If you've already got on a payment plan and you're paying it back, you can disregard that. However, if you have a full maximum loan on your policy and loan interest is due, you cannot ignore that because you've got to get that paid or your policy could lapse.
Something else about the interest that should be aware of is that if we have cash value in our policy and our policy anniversary is 4 months from now and we borrow that cash value, the insurance company is only going to charge us 4 months of interest, not a full year, because we didn't use the money the other 8 months out of the year. And so the interest will be lower that year. Beginning the second year, if we haven't paid that loan off, then they're going to charge
at the policy anniversary date.
The policy anniversary, they'll charge us a full year of interest. But like you're saying, if you're paying that loan off every month, the amount of interest that you're going to owe on your policy anniversary is going to go down.
Yeah, the insurance company is looking at that snapshot once a year. What's the loan balance? What's the interest that's going to be due? They can either add it to the loan balance or you can pay it out of pocket. And if you're making loan repayments throughout the year that is sufficient to cover that interest for the year, no problem with just letting them add it to the loan balance.
Those are just a few of the stories from McPhee Insurance clients on how they use infinite banking.
If you have a story about using infinite banking that you would like to share to encourage others, please write to us, producer@wealthtalks.com.
And come back next week when we decide if Susie Orman had any right to tell someone they couldn't have a pet. Right here next week on Wealth Talks.